There you go. So first of all, I've got £100 here. Now, eagle-eyed amongst you will see this is actually Monopoly money, so no need to mug me on the way out because you won't make much money. So I want to invest this £100, and I've got a couple of options. I could either invest in a Whizzy umbrella, or I could invest in an ice cream maker. So it's a typical day in the UK. It's wet and windy, it's horrible. I'm thinking the ice cream maker is probably not a great choice. So I'll go and buy this Whizzy umbrella. It's fantastic. It's one of those umbrellas that doesn't fold inside out when it gets windy, so it's really good. I tell my friends, I tell my colleagues, I tell my family. They all go out and buy one. They tell their friends, etc., etc. So there's a spike in demand for these Whizzy umbrellas. There aren't that many of them around, so it's getting quite popular. Now the ice cream maker, there aren't many of those being sold at the moment, so this is getting quite tricky. So before long, suddenly the price of the umbrella goes up. So now it's no longer £100, haven't got enough, it's £120. And actually I could sell my umbrella, which is second hand, for £100, and even though it's being used. Now the ice cream maker, the price has dropped now to say £60. So it's quite cheap. There's a few people sniffing around now, they think actually this is a bit of a bargain. Perhaps they're a bit more optimistic. The sun's going to come out at some point. But there's still far less demand for those ice cream makers. But there's a big gap now between the price of the Whizzy umbrella and the price of the ice cream maker. It's almost twice the price. And there's a big divergence here. And this is a little bit like the commercial property investment market as I see it in the last, that's how it changes, in the last couple of years. And there's been a real polarization in the market between those assets that everybody wants and those assets that really investors are not that keen on. So I'm just going to take you through those sectors and we'll just discuss that a bit further. So we have to start with industrial. Dan's just explained why. It's a really hot market. This is where all investors want to be at the moment. Everybody and their dog wants to try and invest in it. And it's because of that underlying strength in the occupational market. And then more importantly, it's because of that perception that we're going to get further rental growth in that sector. And this is why we're starting to see yields of 4 to 5% for prime assets in the industrial sector, because they're expecting that rent to increase, so that return will gradually increase. Now, will it? That's the big question. We're also seeing secondary properties come in, so that's getting more expensive. So that may be in the sort of 6 to 7% territory for not so great, but industrial investments. So there's these low returns are being expected by investors because they think it's going to increase over time. As a live example, Concord Park, which is a new industrial scheme in Sedgensworth, is currently on the market for just under £20 million, and that's a 4.5% initial yield. And that's with 3 units which are vacant and with some rent guarantees. So it's pretty steamy money, but it is brand new, and there is a perception that will grow. Now, for different reasons, we've also seen growth in demand from investors for properties that are simply let on a long-term lease. So we're thinking 10 years plus here. Now, the rationale here is less about rental growth, and it's more about the guarantee that they're going to get that money. So they're going to send out their rent check, and they're going to get paid every month or every quarter without any hassle, minimal management issues, and that's really driving the private investor demand for just long-let investments. The sectors that have most benefited from this demand have been the food sectors and the convenience stores. So we've all seen the Lidl and the Aldis fighting for a site. There's plenty of examples of new housing estates being built where there's kind of one opportunity to put a convenience store in there. So you've got the likes of Sainsbury's and Tesco and Co-op main brands and Southern Co-op all fighting for that one chance. Obviously, what does that do? Supply and demand, rents are going up. Also, they're prepared to take longer leases in order to secure that for as long as possible as possible. So yield-wise, we're seeing yields similar to industrial, down at that 4 to 5% level for the very best food store, convenience store investments. So similar. So that's over here. That's the investments everybody wants to buy at the moment. Now, in contrast, retail and leisure clearly has been through a pretty tough period over the last 18 months or so. We've all seen what impact that's had on the high street. It's a tough time. But those tenants that are able and willing to trade and are doing quite well are actually in a really strong negotiating position, because now they can actually say to their landlords, well, yeah, we'll stay, but they're going to push down on the rents. Not only that, they're going to want a little bit more flexibility in that lease. And these two things are exactly what investors don't want. They don't want flexibility, they want long leases, and they don't want the rents to be going downwards. So that risk profile has changed in that market. It wasn't great pre-pandemic, but it's got a lot worse. And so we've seen yields moving out in the retail and leisure sector quite dramatically, in fact. And there's plenty of examples of investments being sold for double-digit yields in the retail and leisure sector. And it's a tough place to be. And even in those cathedral city towns, the Winchesters and cathedrals, we're seeing yields perhaps not as bad as that, but still 3-4% worse than they were, or better, depending how you look at it, than they were pre-pandemic. I think one of the other key factors is the moratorium on taking action against those tenants that are not paying rent as well. So that's been extended. It's been extended again to March next year. And so at the moment we don't really know what the fallout's going to be in that sector, and it has impacted retail and leisure more than others. But once we can get into that market, and once landlords start to take action, is that going to worsen that market? So that risk, that uncertainty, that's what investors don't like. Hence, they're not prepared to pay the big prices that they will pay for industrial. Now, one part of the retail warehouse sector that's actually done quite well recently and remains pretty buoyant is retail warehouse sector. Interestingly, I think it did fall victim to the general retail slump at the beginning of the pandemic. So we saw a lot of panic around retail warehouse investment, but it came back quite quickly. And that's because really two factors. One, many businesses in that sector were able to operate. So we all saw those retail warehouses starting to reopen during the pandemic quicker than the high street. So that gave a bit of confidence in the market. And also we've seen the gap between those rents at the retail warehouse level and industrial start to squeeze. So yes, there's a bit of pressure on retail warehouse rents in negotiations. We've seen industrials coming up, so the gap's smaller, and therefore investors are a bit more confident that in fact they're getting what is essentially a warehouse, albeit less as a retail warehouse. So that market's coming back. It's not as strong as prime industrial, but it's not too far behind, in the best locations. Office market. Now, my view is this is still in a bit of a state of flux generally, because we really don't know what's going to happen. Nella spoke, at length about what's happening in that market, so I'm not going to go over the same things. But clearly, home working and the way we use our space is changing, and so that means it's uncertain. And again, investors not massively keen on uncertainty, and that's having an impact on where prices are and where yields are. The level of transactions in office investments has certainly been lower in the sort of South Coast region in particular in the last 18 months or so, but there definitely is a bit more confidence out there. We've all gone back to our offices in the main. Businesses are starting to move. There is a lack of supply, and therefore actually we're seeing some pretty good rents actually for some office moves. So that's breeding some confidence, and we're starting to see yields kind of settling down at that 7 and 8% level now for good quality office investments that are let on sort of traditional leases with perhaps 5 years to go or the like. So you've got industrial over here at 4 or 5% at the very best. You've got your offices in the middle at 7 and 8%, and then you've got your basket case retail over here at double-digit yields. So who's investing? Who are these investors who have far more money than me? There are really 4 types of investor. You've got your institutional investors, your UK institutions, your funds, and they tend to be looking for larger lot sizes. There's a little bit of a herd mentality, so they all tend to move in the same place. And clearly at the moment we're seeing them all move towards buying industrial and trying to sell out of retail and leisure. They tend to look at investment in a slightly more sophisticated way. So they might be doing internal rates of return analysis, total return analysis, but more sophisticated than many other investors. They're trying to balance their portfolio. So you might have one fund that actually is overweight in a particular sector. At the moment, many of them would like to increase their weighting in industrial, hence what they're trying to look for. And they can move really quickly and have a lot of firepower because they can throw a lot of resource at buying investments. So when they're in the market and they've got something they like, they can be quite a compelling buyer. Now, the Property Investor Bulletin is some data that we look at quite a lot. And they were actually significant net sellers in the last 12 months. So they were selling a lot more than they were buying as a round across the UK. Then you've got your private investors. So in complete contrast, your private investor is looking for much smaller lot sizes. They're more focused on security of income, long-term income, so convenience stores and food stores. They don't want any management hassle, so it's minimal management hassle, preferably one tenant. They just pay the rent. A bit more focused on initial yield, so it's their initial return. They're probably not going to do lots of analysis on the future. Typically cash. Many private investors are cash rich and are trying to get a better return. Not many are really geared up at the moment. And they tend to be looking for solace units. One unit is kind of preferred in most cases. Most sectors they'll look at, but really, again, it's industrial units, trade counters, and the convenience stores or food stores. And again, Property Investor Bulletin is saying that they were net sellers in the last 12 months. Then you've got your propcos, your property companies. They're somewhere in between the two. So they tend to be looking at your mid-size investments. They're often geared because they're trying to maximize their returns. So there's, that's a better way of generating some profit. They're looking for added value. They want to do something with this property. They're not going to be benign. They've got resource to throw at it, and they want to try and generate some value. They're more likely to trade than hold. So a private investor will probably hold unless it's, there's a very strong price being offered. Whereas a propco is more likely to think about moving it on once they've added that value. They're not very competitive for dry investments. They typically won't be quite there for some of the, the really long let investments. And they're just generally far more opportunistic. So if something comes along tomorrow that might work, they can throw things at it very quickly because that's what they're looking for, the chance to add some value quickly. But again, last 12 months, they've been net sellers across the UK. So who are the net buyers? Someone's got to be buying it all. So that has actually been the overseas buyers over the last 12 months. Now, a lot of that is skewed towards large value assets, so it does have an impact, but they have been the only sector that have been net buyers. They tend to like large lot sizes, familiar locations, London, regional cities, trophy buildings, portfolios, but you have to remember they're looking at investments on a global context, so it's slightly different. And actually, I think it gives us some confidence about the UK that overseas buyers have been buying lots of assets even during the pandemic within the UK. So that says something about the strength of the UK as an economy and as a place to invest. So I think we can be pretty optimistic about that. I'm just going to finally finish on just to show you three graphs or charts. And again, these are all from the Property Investors Bulletin. The first one is a graph, if you can see that, showing levels of activity and transactions in the 12 months to September 2019. So this was before we even knew what COVID was and furlough meant. So in this period, we had around £30 billion of transactions across the UK. So that was a normal-ish year. You can see there's quite a large chunk, which is central London offices. Industrial is pretty strong there, but similar to where offices are. Don't need to look at the detail here, it's just to see the changes, that's what we're looking at. So the next graph is going to show us what happened during the year to September in 2020. Now remember, some of that year was okay actually, but not all of it. So the main changes we saw, massive slump in central London office investment, so that dropped right back. Offices dropped back, not quite so much, but there was still a reduction in transactions. We saw retail drop back. Industrial stayed about the same, so it was pretty much the same level of transactions. This was within a market where it reduced from 30 to 25 billion pounds of transactions, which actually doesn't sound too bad, does it, during a pandemic? But it was quite a drop across the UK. And we saw leisure really drop back significantly. I'm not going to talk about alternatives because there's lots of things in that. And then the final graph is the last 12 months to September this year, just to see what's happened. There we go, sorry. So during the last 12 months, we've seen a resurgence of activity. So it's gone from 30 to 25 to 36 billion pounds of investment transactions in the UK. So it's really come back. So there was obviously a lot of pent-up demand there to do some investments. But you can see, it's pretty obvious who the winner is. We've talked about it already on a few occasions today, but the industrial spike is enormous. That's 3 times what it was before we even knew what pandemic was. So the interest and the demand and the deals within the industrial sector are threefold where they were 2 years ago. And that is the biggest change you can see within this graph. Offices all the other ones have kind of moved around a bit. Leisure stayed really low. Retail's been about the same, but probably buoyed by the food stores, etc. But it's that industrial one, which I'll leave you with, that's the real spike. And big question, of course, for any investor is, what's going to happen? What's going to be the next big thing in the years to come? Thank you.
Does anybody have any questions?
Thank you, Russell. We've got a very interesting talk. A couple of questions for you. Where would you see prime industrial yield? And where would you consider the opportunity to be for investors?
That's a very pertinent question. Prime industrial yields, it depends where you are. I would say a normal prime industrial yield is around the 4 to 4.5% level, but there certainly are anomalies out there, and there are some very large transactions at far steamier yields, which will be for other reasons, whether that's because they're so close to London, or, to be frank, it will be down to a perception of significant rental growth. That's what's going to drive it. But yeah, I'd say safely, your 4 to 4.5 is a pretty good yield for prime industrial at the moment.
And the opportunities?
The opportunities for industrial? Or?
No, the opportunities generally for investing in the market.
Well, I can't see that polarisation of the market staying the same. So you've got a massive gap, which is where I started. That will squeeze again, as we've seen in the past. So it's a brave man to say this, but if you're investing at the higher risk end and you're careful, then that's where you're going to see the compression. I think it's difficult to see general compression on the other side unless we see that growth in rents. So the opportunities are for those that are willing to take a risk.
In the retail sector?
Well, yeah. Just be careful. Be careful. So.
Thank you very much.